$1 trillion, that's how much the IMF is looking for in extra funds to tackle the Eurozone debt crisis, according to media reports today. Euro-dollar jumps to session highs above 128 following that news, but momentum running out ahead of the 21-day moving average. Peripheral debt also now outperforming. Italian bonds get an extra lift after Fitch says it does not expect Rome to default, driving yields below the 6.5% mark. But Germany still enjoys a big jump in bids at this morning's auction of two-year debt. Safe haven demand stays strong as Greece prepares to restart make-or-break talks with private creditors. Let's talk about the IMF move and what this means for the FX markets. I'm joined by Neil Kimberly. All right, we're at, what is it, around 128 now. Are the people you talk to impressed by this IMF
No,
move?
frankly, no, Axel. I mean, we've had the move up, the knee-jerk reaction to the headlines, but we haven't seen the detail yet. But we've been up to around that 128, 40, 50 level, and as we're coming on air now, there are more and more offers building between 128.35 and 128.60 from people who are now saying, hang on a second, we're not being taken in by this one. So that's heavy up there. There were some bids coming in around 128, the figure, so we're kind of stuck at the moment.
But why aren't they being taken? I mean, yesterday we talked about these guys needing a sign that the leaders are serious. Yeah. This is a sign, albeit a small one.
It's a sign that the people on our side, the West, are trying to drive this forward. But let's think about this. It's that Jerry Maguire case. Show me the money. Where's it going to come from, Axel? The BRICS is where the names have been mentioned. Well, China's seen capital outflows over the last couple of months. Russia's foreign exchange reserves have been edging down. India, as we all know, has been selling bucket loads of dollars to try and stabilise the rupee. The World Bank this morning has come out and told the developing markets, be on your guard, because this could go a bit pear-shaped, be worse than 2008. So why would these guys want to step up, chuck a load of money at the IMF to pay for Greeks to retire early? It ain't going to happen, in my opinion.
All right, let's throw in these Greek talks as well. What are you hearing on that front? The fact that they're back at the table, is that a good thing? Is that a sign of seriousness?
It is a sign of seriousness, but at the end of the day, this is supposed to be the special case, isn't it? They're holding the gun to the head of the private sector. As we said yesterday, you've got more senior creditors now than you can shake a stick at, which means the subordinated debtors take a bigger and bigger hit. That may be a special case, but it's also a template. But in the case of Greece, one other thing here, going back to the IMF. Remember 1997, the IMF made Asia bleed to get that money. Compared to that, they've treated the Greeks